Okay, today we're going to talk about dollar cost averaging, and this is a mathematical example. It kind of ties into episode 38, the tail end of the podcast, where I was talking about dollar cost averaging, and I made a comment. I said, if you're in a retirement plan versus having a straight investment account, you actually make more money when the market's down. So I wanted to mathematically show you that, how, from a number standpoint, how that really happens. Now, okay, so what I did is I made this scenario, and let me just zoom in just a little bit so you can see this. So the scenario is, this is a person who makes $60,000 a year, and they're contributing 3% of their paycheck into a company match. So, and the company's matching 3%, which is very unusual for companies to match. But anyway, so there's 2 years in the pay period. They get paid on the 1st and the 15th, and this is going to go on for 24 months. So in the first scenario, I'm saying that the market goes down, and as I mentioned in the podcast, it stays down. If it can stay down for a great length in time, 6 months, 1 year, 2 years, things like that. And if you are far away from retirement, say more than 5 years, it's an advantage for the market to go down because you make more money. And I'm going to show you that mathematically. So in this case, they're doing $75, and then it's a company match of $75. So total pay for the pay period is $150. Now, in this case, I'm using a mutual fund share price. It's a fictitious number. I said it's $25 a share. And so you can see that they bought 6 shares. Total transaction for the shares was 6 shares. Okay, so then in this case, then the market starts to go down, as you can see. Now, these are total shares being accumulated along the way. So we're adding the 6 shares, plus he got 6.12 shares, so for a total of 12 shares. So then it goes down. You can see the share price as it falls, and it falls down to about $16.75, and it stays down for about 6 months. But you keep plowing money in, So now in the other scenario, I'll show you this. On the other side, I said that the scenario is the market goes up slightly. It does not fall. And as a result, in this case, there is no drop in share price on the $25 a share. So you keep putting your $150 in for the pay period. Keeps going in there. Sorry, pardon me about my voice. So then at the end of the 2 years, in this scenario I gave you, for it to work, I said that you ended up at $30 a share. And then this scenario, I said, okay, same thing, that the market goes back up to $30 a share. Now, that's about, if you look at the math, I'm saying it's a conservative, it's a conservative 10% a year on the mutual funds. So that's $2.50 a share. Times 2, because it's 2 years, 10%, total of 20 for the 2 years. So it goes up from $25 to $30. So we're not talking about 15, 20%. These are just very conservative numbers. So then you end up, and this is where dollar cost averaging comes into play. So now the average cost is actually lower than the $30 share. It's at $22.02. Now over here, the average cost is $29.93. So at the end, you ended up with 333 shares because of dollar cost averaging, because you are contributing periodically. And over here, you only ended up with 263 shares. You multiply that times $30, you earned $10,000 in 2 years just because the market went down. Over here, because the market didn't go down, you ended up with $7,896. So, in conclusion, bad markets contribute to accumulating more shares for a possible higher long-term performance in retirement plans. So like I said in the podcast, don't be sad when the market goes down. Be happy if you're in a retirement plan and you're contributing. Now, once that nest egg gets pretty big and you're within 5 years of retirement, that's when you need to call your investment advisor and see what the economy's doing. Should I stay in equities, or do I have the risk of losing my principal? And then he may advise you to shift some money over to fixed income and move out of equities so you don't lose that nest egg, or even get more conservative with it because you're within 5 years of retirement, just depending upon what the economy is doing and looking at the economic indicators. The other thing that I didn't mention in this is that this does not take into account the compounding effect from dividends and capital gains, which would actually add to the performance. So you have all these shares are actually paying dividends on a quarterly basis, and that gets reinvested. So these numbers, if this actually happened, and of course, this is fictitious, just a hypothetical example. But if you had the dividend reinvestment program here, these numbers would actually be higher because of the dividend reinvestment program. And anyway, I just wanted to point that out. So this is an example, again, a mathematical example of dollar cost averaging. Like I said, bad markets really help you if you are contributing on a periodic basis. It's much different than if you had an investment account. Again, if you had an investment account and the market's moving down, sure, you want to move to a more conservative basis, or maybe get out of the market, whatever it may be, or have an advisor if you're in a managed program who's making those adjustments for you. And we do that here at Cantu Tactical Wealth Management for our current clients. We're a tactical manager, and we sector rotate to reflect what's going on in the economy. But again, back to dollar cost averaging. It's a benefit to see, and now you can mathematically see the benefit if the market goes down. That concludes my presentation. And I have a few disclaimers that are required by our state securities. Just have a listen. Thank you so much.
Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss, and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management and Joe Cantu are a fiduciary firm and registered investment advisor in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.